Thank you so much for signing up. I'm really excited about the webinar that we have today. This is something that I've been working on for, if you want, 25 years, because I've been building passive income at first unintentionally. And over the years, I became more intentional about doing it. And I kind of explain the journey in the book that we see the cover of here that was released recently. So I'm gonna turn this one off real quick so we don't have any bandwidth issues. Okay, good. Yeah, and more recently, I actually started applying a strategy in the stock market using options that kind of changed the game a little bit. But yeah, let's start gradually. I'm gonna kind of dive into the slides and let's see. Yeah, so let's first start with a little question here, true or false. If you want, you can write your answer in the chat. Just write a T for true or F for false. And the question we want to cover to get started is, do you need to be a Wall Street expert to earn money with stock options? Do you think that's true or is that false? Give you like a moment to respond here. That is actually false. You don't have to be an expert. You can earn money with stock options, even if you don't have a deep financial education. Thank you, Gerald. I see your response there. That's a match. Good job. You can actually just get a training or do your own research. There's a lot of content on how to do this. A lot of good books published, a lot of YouTube videos. There are many ways to learn it. And of course, you can also get a coaching from people to speed up your journey. Let's go to question number 2 here. We have the question, selling options is too risky for everyday people. Is that true or false? Give you another moment to respond here. Is it too risky? Maybe only very experienced traders should do this because everyday people, it's kind of too challenging for them. They shouldn't get involved. I see some Fs in the chat there. Okay, one T. Okay, so we have a little bit of divided opinions. Okay, is it too risky? And yeah, I fully understand why we have a little bit of a mix of opinions here. So from my perspective, since I have the experience, I have the understanding how this works, I would say this is false, because once you know how options work and how to use them with a managed risk in a low risk scenario, then it's no longer too risky. And everybody can learn that. I have not studied finance. I don't have an MBA or anything like that. I just have an education as a software engineer, a little bit of accounting on top of that, a little bit of marketing, but nothing that would give me a deep understanding in the financial market other than what I learned just studying certain books I was interested in and following some people in this market and things like that. Okay, let's go to the next question. Again, true or false? You need a lot of money to get started with options. Is that true or false? Put it in the chat. Give you a moment here. Do you need like $100,000? Do you need maybe even $1 million because options are traded in 100 blocks of 100 shares? Okay, I see some false answers here. Mostly false. Yeah. Okay, question mark. Thank you for being honest, Nina. Appreciate it. Yeah, that's actually true. You can get started with options depending on the price of the stock. I've sold options for some stocks that are traded at close to $2, and $2 times 100 to kind of sell one option means you need $200 in your account. So it's possible to do it with small amounts. I recommend maybe having $1,000 to start with, but even learning the strategy, it's actually the best if you just do it in paper mode and don't put any actual money on the line. Let's go to the next one here. True or false, learning options is complicated and time consuming. Looking forward to see what you guys think about this question here. Is it a lot to learn? I know the concepts are a little different if you're not very familiar with the stock market, or maybe if you have never looked at how options work deeply under the hood. Is it hard to learn? Okay, we have one true from Nina. Thank you. Another depends from Gerald. Yeah. It depends a little bit on how deep you want to go, I would say, but the basic concepts of what options are, how they work, it's actually pretty simple. I would say you can get a very good grasp of how options work and even have practical experience buying and selling them by just spending 5 to 10 hours learning and using what you learn. So I would say it's not very hard. It takes a little bit of an investment. We kind of have to shift some things in our mind to get a full grasp of it, but it's definitely doable. Okay, we have one more, I think. True or false, there's a way to make consistent returns selling options with the right knowledge and support. Would this also be false, or would we think this is true? Yeah, I saw the other question, Jen. You hope that I make selling options easy or learning how to do it. Yeah, definitely try to do that. Okay. Yeah. See a lot of truth in the response here. That's exactly right. So with the right knowledge and the right support, it's actually very possible, and I would say easy, to get consistent return selling options. Now that I've done this for close to a year, just the selling option side, I would say it can actually get a little bit boring, because if you implement the basic strategy, you spend less than an hour a week or a month putting in your trades, and then you basically wait a week or a month to see what happened with your options trade. So it's pretty simple and doesn't require a lot of skill once you got a handle of it. Okay, since this is a financial webinar, I have to put a little disclaimer here as well, and let everyone know this is for educational and informal purposes only. This doesn't contain financial, investment, tax, or legal advice. So returns mentioned here are not guarantees of future results. Things can always change in the market, and of course, as with any trading, with options trading, there's also significant risk involved, and I advise to consult professionals, to get help, to have a financial advisor if you have significant investments or investments that your life depends on. Definitely good to keep all of these things in mind. Okay, let's go to the next slide. Let's go a little bit into the challenges that come with the topic of investing in general. So a lot of investors that get into the stock market, either they invest in ETFs like the S&P 500, or maybe some dividend funds or dividend growth funds. That can be a little bit challenging because the returns tend to be slow. So it's a great strategy if you have a long-term perspective and you have a lot of patience, you're not very close to retirement age, and you just want to watch your money grow over 10, 20, 30, maybe even 40 years. It's a great strategy. But if you want to scale your investment a little faster and see results, then this can be a real struggle. I've seen people try here to buy individual stocks, and one thing that often happens is people follow some kind of trending stock or meme stock, maybe GameStop or something like that. It's currently trending on social media, then they put some money on it. And usually when something is trending like that, that's near the top of the price, and there's not enough real value behind the company to keep going or even stay at that level. And then the price turns, and before you have time to get out of the trade and sell the stock, you actually lost significant amounts of money. So I definitely advise against following any kind of meme stocks or investing in individual companies that you have not thoroughly looked at what's kind of happening under the hood, what is the intrinsic value at. And yeah, we also have some training material on how to do that, how to kind of cover your due diligence. And Warren Buffett would be with you on this. He basically spends days investigating a company before he decides to make a significant investment. And that's kind of what the pros do. And as individual investors, we may not have the time to go that deep, but we should still do our due diligence and maybe read secondary material from somebody who has studied it deeply, get a few different opinions, kind of get their perspective before we choose a company, even for the option selling strategy. Okay, and another struggle that can come with investing is the complexity. There's so many companies to choose from, so many metrics to watch. It's easy to feel overwhelmed or not know what to watch out for and what to follow. It's another kind of challenge that people struggle with. We also have risk involved here. People don't want to lose their hard-earned money. In general, it's a good idea to invest money in the stock market, or whenever you learn something new that you can afford to lose, because that way you're not putting your livelihood on the line, and you're basically learning something with money that is kind of something that you can grow over time, and you're okay with certain risks that you otherwise would not be okay with. For example, if you have like a very long-term perspective, you would probably have some assets in your portfolio that are more stable, maybe S&P 500 index, but you could also have, if your portfolio is set up in a strategic way, you could have some components that are a bit more risky, where you invest in smaller stocks and maybe also some smaller companies short after the IPO or so. And you're okay with taking more risk in that area because the majority of your portfolio is kind of more balanced. But all of these strategies on how to manage a portfolio well and how to plan for the future, that can be a struggle if you don't have a lot of experience and don't want to talk all of the details of your portfolio through with your advisor whenever you want to make a change. So that's why it can be a struggle for people. If you want to try to learn how to trade options on your own, it's definitely possible. The main challenge there, I think, is knowing what resources to choose and kind of what to focus on, what to implement and what to ignore. Because there's so much content, it can go very deep in all of the Greek metrics of the options and all of that. And to be frank, that's not something I personally look at very much. When I consider an options trade, I mostly look at what kind of return do I get on this trade on a weekly basis, on a monthly basis, and do I like the company? What happens if the price drops? Am I okay with owning the company if the price drops? And then I look at the latest earnings reports of a company. Do they have a strong growth trend? Am I okay with investing in this, even if something shifts in the industry or the company? Do I have a good long-term perspective on the health of this company? And if all of those questions get a yes as an answer, then I'm okay with making the trade. Not all money on one horse, of course. It's always a balanced approach. But yeah, those are some good things to double check. But of course, if you want to learn it all on your own, you kind of have to deal with this overwhelm from what books to read, what YouTube videos to watch, who to follow, who to listen to. It's definitely possible to get there, but I don't think it's the fastest way, and you might make some mistakes on the way that could potentially be expensive. And on that note, it's also good to have healthy support when you're learning something new like this. It's good to have accountability so you don't give up along the journey because something didn't go as planned, but you actually keep learning, keep growing, turn your experiences into an eventual success. And having support, like some kind of coaching support or a community around you, can be really helpful to make the investing journey successful. Okay, now let's look a little bit on the bright side. What does 40% ROI, return on investment, actually mean? If you can achieve this on average on any kind of investment strategy, it basically means you can double your portfolio every 2 years, actually a little sooner than every 2 years if that's your average return. And that's really, really game-changing. And this return is achievable if you don't use margin in your account. Once you're more experienced and maybe you have an account where you're okay to take on a bit more risk, then you can choose to use some level of margin there. And then you can even scale your returns by stacking a number of different strategies that are used today and scale them to 90% average ROI or even higher. So that's kind of my goal that I have for this year. I'm aiming for 90% ROI on my portfolio, and I also share some results from last year later that kind of show that this is the direction that's definitely achievable. But to start, I would definitely focus on 45% ROI. Don't use any margin in the beginning. Kind of keep it simple. Make sure you understand the strategy well. Start with smaller amounts of money, and then as you get more comfortable over time of a few months, then you can consider to increase your investments and kind of scale your returns. Okay, so for the rest of the slides, I think we'll be talking about 45% ROI, but keep in mind the other return is possible, and also in our training material, we kind of address that, how to get there. Okay, so financial freedom awaits with this kind of return. We would be able to make our job optional. That's actually the place where I'm at right now. I've been scaling passive income over the last several years, and now have multiple six figures of passive income that are coming in every year. So the job has become optional. But I love working in software engineering. I love the people I work with. So I choose to continue to work in this field. And since selling options doesn't take much of my time, I just do it on the side. And that's a choice. It's good if you have the freedom to make it. Not everyone would make the same choice there. But I think having this freedom is really something to aim for. And even if it takes us 5, 10 years or more to get there, it's a worthy goal to pursue. Some people like to implement a strategy like this and then kind of go for early retirement. I have some friends and acquaintances that have done that, and that can be a pretty fun thing. Some people like to travel, or maybe even work a little bit part-time while they travel, but kind of spend most of their time exploring the world. I heard one quote recently where somebody said, the world is like an open book. And if we don't travel, we have really only explored like one page of that book, maybe two. But there's an entire book that we can kind of scroll through and see different things and aspects of the world, the people, and the different cultures. So that's the one perspective that people who like to travel and go for early retirement oftentimes have. I've traveled a good bit in my past experience, probably visited 7 to 9 different countries. Of course, that's not very much compared to how many I could potentially visit, but I feel like I've seen a decent part of the world. I've visited most continents, and yeah, it's been a great experience. Okay, with the financial confidence of being able to earn 45% ROI, then you can really take control of your future. This can also give you confidence in other areas of your life if kind of the financial space is more stable. And it really depends on how personality is set up. Some people care more about finances, some people care less. But it's good to at least have a healthy foundation there, so it's not something that holds you back or limits you in your decisions. So in this webinar, we'll basically review a proven strategy that helps us use option selling for generating consistent return. 45% ROI is what we aim for, as I mentioned. And we will also look at risk management. How can we identify the best options, the best option trades to kind of reduce our risk and make sure we have a good return for the risk that we are taking on. And we will also look at some easy steps, how to get started, what to watch out for, what information do we need, what are kind of the minimum requirements until we can kind of get our feet wet and start implementing what we learn with the strategy. And we'll also see how the support of a community can really help us be successful in our journey to learn selling options, and how we can receive guidance, not just from people who are coaches in our life, but also from what other people are using, experiencing, something that they implemented that really worked well. I'm part of a community of people that sell options, and some people in that community, they actually have account balances of over 10 million. And those are people I like to learn from, because I'm still pretty far away from that kind of account balance. But it's good to kind of learn from people who are already at the next level, see what they are doing, how they are managing their risk. So we can kind of implement whatever they're doing at a smaller scale, wherever it makes sense. And that's what community is great for and can help us with. Yeah, so I already shared this. I've scaled passive income for 25 years, also helped many people create passive income, and was able to achieve an average 45% ROI. I'm saying 45% here because I'm actually using the options selling strategy in 4 different accounts, 4 different portfolios today. 2 of them are Roth IRA accounts, which I will touch on later. And the others are independent stock investment accounts in different companies. I'm kind of exploring how that works with different brokers as well. And on average, I've received 45% ROI, but with the main account, we're actually closer to 100% ROI if you kind of break the returns down on an annual basis. I've only really implemented the strategy for larger amounts of money in the second half of last year. But if we look at the returns and we think that similar returns are possible for the entire year, then it would be closer to 100%. And we'll see that in a later graph. Yeah, so the training material that we are creating is for everyday investors. Doesn't require that you're a Wall Street professional or have a lot of experience in the space. We're really trying to explain simple terms from the ground up, so it's easy to get started and kind of grow as you scale your account. We also want to provide ongoing support, as well as have a thriving community. So one thing that we started doing is bi-weekly calls with clients that are implementing the strategy, kind of help them get consistent returns, and if they run into any questions, trying to figure out how certain things work in the stockbroker that they use, and we help them understand that and move forward in that area. We have expert instructors that do our training. We are actually still in the process of building our video training material, so that's something that we'll be publishing over the next 6 months. But we already have many experts in the background to learn from, and I'm looking forward what will be published, both on social media accounts and also in our training program. Okay, let's kind of review the basics of what options are and how option selling would work. An options contract is something that gives the buyer of the option the right to exercise the contract. That's really important to keep in mind, because the roles of the buyer and the seller are very different here. And the seller is required to fulfill the options contract whenever the buyer wants to exercise the options, so to speak, or under certain conditions at the time that the option expires, then it would get automatically exercised if a specific condition is met. And we'll talk about that in a minute. So the seller of the options contract collects a premium for selling the option, kind of in exchange for the obligation that they are taking on by selling it. Selling an option is also sometimes called writing an option, because it's a bit like you're writing a contract, you're writing a guarantee for the buyer that you're going to do certain things by the expiration date of the option if the buyer chooses to exercise the option, or if the market price moves past the strike price, basically, or in a specific vicinity of the strike price. Okay, and then there are 2 different types of option contracts. There are put and call options. To be honest, this took me a little while to fully understand, so don't be discouraged if you don't fully grasp this in the beginning. I would recommend reading definitions of this either on different pages of the internet. Investopedia.com or something like that can be helpful. I also like having conversations with this type of stuff with ChatGPT and other large language models. Then you can use them a little bit like a coach, ask them some questions. If they respond with something that you don't understand, some terms you're not familiar with, then you can ask some deeper questions. And there are actually some chatbots that are so smart that are not just giving you a response. They also make suggestions for follow-up things you can ask, or how you can basically help them refine the response better. I had that experience recently with Grok AI, the one from X.com, that was trained, I think, on the largest cluster of GPUs. So that's kind of assembled so far. And I compared a response from that model with ChatGPT and I think one other model. And the interesting thing with Grok AI, it was version 3, was that it actually asked really good coaching questions that helped the conversation to go much deeper. With the other chatbots, I was already done. I got my answer and I was kind of okay. But by asking these follow-up questions, Grok actually caused me to go deeper. And I ended up with a much better answer because I answered a series of follow-up questions that the model had for me. And then it was able to give me much more specific and more helpful advice. So you can utilize tools like this to learn options trading. It's very efficient. It's a tool that was not available 5 years ago, but we have it at our disposal today. Many versions of this are available for free. Let's take advantage, I would say. So a put contract is basically a contract, an options contract, where the seller gives the buyer the right to sell or to give shares to the seller for a certain strike price, for an agreed upon price. And in the US, this is always 100 shares of a stock. In the UK, the contract size is 1,000 shares. So I haven't really looked at stock prices there, but I hope that the average stock price is also lower. Otherwise, it would require a lot more funds to even sell a single option. But yeah, there are some small differences like this. But for most people in attendance here, we probably only have to worry about the US options or stock market. Yeah, so if a put contract gets exercised, 100 shares of the stock go from the buyer to the seller. And in exchange, the buyer gets the strike price of the stock times 100. So that means when we sell such a put contract, we need to have that amount of money ready to give to the buyer if they decide to exercise, or if the market price moves below the put price by the expiration date. So kind of at that point, then the option or the shares change hands and the kind of stock options contract goes away because it expired. On the other side, on the call contract, for example, if that gets exercised, then 100 shares of stock go from the seller to the buyer. So kind of the direction that the shares move is different. And the reason that a buyer would ever want to buy a call contract to have this happen is because they think the price of the stock will go higher and will hopefully go beyond the strike price before the expiration. And if that happens, then the buyer kind of gets a return on their investment. First, they have to pay the premium to the seller. And then if the stock moves enough past the strike price, if you kind of have to make up the premium on that move as well, then you can potentially make a profit on that stock. And the profit can be huge if you can kind of do that right before a large price moves happens. But the challenge with this is most of the time, the stock does not move significantly. So we'll look also a little bit at this later. The majority of the time, the option seller actually has a better deal. They get to keep the premium. And bottom line, they make more money than the option buyer, unless you're dealing with a very experienced buyer who kind of knows what they're doing. And yeah, they have so much experience in the market that they might lose a good number of trades, but somehow they make enough on the ones that they win at that they can make up for the losses. But it's much easier to make a consistent return on the selling side. So I'd highly recommend to stay there until you really have the 45% ROI. And once you get there on a consistent basis, then you can consider maybe mixing in options buy here and there it can help to stabilize the portfolio or to kind of capitalize on growth that you expect in a certain company. But no, that's always pretty risky to do. So we need to have a good strategy behind that as well. And that's definitely harder to learn than just a basic selling option strategy, which is why we focus on that in our training. Okay, yeah, and the exchange of the shares always happens at the strike price. That's the same whether it's a put or call contract. And by the way, if you have any questions about any of this, feel free to put them in the chat. I'll try to answer them throughout the webinar if it fits into the topic. Otherwise, I'll save them for the end. So regardless of if you have a question about any of the content or something for later, feel free to write it in the chat, and then we can kind of address it towards the end. Okay. So yeah, selling versus buying, I already went over this a little bit. So the option selling strategy statistically really favors the seller. If you look at analytics over the entire market, the reason why most option sellers make money is because the buyers, the majority of the buyers, are okay with losing some money. And there are a few interesting dynamics at play here. These do not cover the entire picture, but I wanted to kind of highlight these. We have a lot of hedge funds in the stock market that are buying shares of companies. And these hedge funds sometimes want to guarantee a certain kind of return to their investors, and they want to reduce the downside of their hedge fund. And the best way that most hedge funds have found to reduce the downside is to buy put options on some of their main holdings, maybe not to cover 100% of the shares that they hold for the specific companies, but to kind of reduce the impact that a stock correction or maybe even a stock market crash would have by kind of buying put options on a little bit of a longer time frame maybe. And then they give some money away by doing that, but they're reducing the downside of their investments. And if they have a good strategy for that, they can actually create a more stable development of the hedge fund. But it's good to keep in mind, any hedge fund that does this, they're also limiting the upside because they have to give some of the earnings of the stocks. And instead of investing them in the company and staying invested, they have to put that into the options premium. And this is where us option sellers can kind of step in and say, hey, we're happy hedge fund to give you a little bit of an insurance here. Just pay us a premium. We want our consistent 1% return a week or 3 to 4% a month. And if you have a larger account or you are a little bit closer to retirement, you can also aim for lower return. You can aim for 0.5% a week. That would still be over 25% a year. It would still be a great return, much better than the S&P 500. So that's really customizable depending on where you want to land with the return on your portfolio. You can run a little bit higher risk and get close to 45% or even more, or you can be on the lower risk side and also reduce your returns. And you kind of become a little bit like an insurance provider for the stock market. So hedge funds are a big player there. They have options premium to give away pretty much every week. And on the other side, we also have some retail investors that learn about options and they think they can predict the stock price. So they buy some options and then that premium can go to the option sellers. So that's another dynamic that can help kind of earn in the market. I prefer to earn money from the hedge funds if I could choose, because I feel like they have more to give away. I don't want to take money from the small investors, but I also cannot control what they do. So if they want to buy an option, then that happens, and it might end up being the other side of my trade. Okay, let's look at one specific example of an option sale. This is from the SoFi Technologies company. It's a fintech or financial technology company. And let's say their current stock price trades at $15. And we want to consider selling a put option for it. And if you remember from the previous slide, a put option requires us to have cash in the account. It's also called a cash secured put, because if that option gets exercised, then the shares from the buyer would get to the seller, right? And in this case, us, since we're the option seller, we might get 100 shares of SoFi at whatever strike price we want to sell the options for. And the strike prices that are available for each stock differ a little bit based on the company, based on what is defined in the market. So for SoFi, for example, since that's a stock that I sell options for myself, I know that you would be able to sell an option at 14.5 strike price here. $14 would work, 13.5 would work. And the lower you go in the strike price, the less the options premium would be. Depending on how much volatility we have in the markets and specifically in the stock, the combination of those two things, we might get more or less premium for an option. So in this example, we're just choosing a strike price of $14 and an expiration of 1 week from now. Since it's Saturday right now, so it would be Friday of next week. And then in exchange for selling this option, we earn a premium of 15 cents per share, which translates into $15 premium earned for the option. So because that's 400 shares of stock, right? That's how options are traded. And if we look at the return on investment for this, we have to have $14 times 100 in our account. So we need to have $1,400 in our account to kind of sell this cash secured put option. And our $1,400 cash, they would earn us a return of a little over 1%, because $15, if you do the math on that, I'm not going to pull out my calculator now, but you're welcome to do it. And that would translate into a little over 1% return. And just doing that pretty consistently and some compounding, missing some weeks where you don't get as much earning, you can actually get to 45% ROI just on average, just doing this if you do a trade like this. And we'll also look at what happens if the option gets exercised and gets assigned, so to speak. I think that might be on the next slide. Yeah, okay. So now let's fast forward 1 week into the future. So the SoFi now trades above $14, or we're actually looking at different cases here. So if SoFi trades above $14, then we just get to keep a 15% premium. We earned our 1% weekly return, or actually a little bit higher, because our cash secured put was $14, and we earned 14 times 100, and we earned 15. And then in the second scenario, number 3, if the market price was below $14, then the options contract would automatically get exercised. It's also possible that the buyer exercises it early. I have not seen that happen very often. Usually if somebody does that, it's on a Thursday or the Friday that the option would expire anyway. I have not experienced them exercising it before that, because usually if they want to kind of capitalize on the movement of the market of the option, it's easier to just sell the option to somebody else than exercise it. You oftentimes get better returns doing that. That's why the exercising happens usually very late, but very close to expiration. But in some cases, it can be sooner, depending on who owns the option and what intentions they have. Okay, so if the price trades below $14, then we kind of have to take 100 shares of SoFi, and we have to buy them at $14 a share. So all of our 1,400 cash secured amount would kind of go towards this. And even if SoFi trades at $13 or $13.50 or whatever it might be, we basically own SoFi at that higher price, at the $14. And in that case, what we would do, since we like to earn premium, we would now look on the call option side and see what kind of premium can we get if we sell a call option at the strike price of $14, or ideally slightly above, depending on how close to the strike price that we got the option for, we got assigned at, or what the market kind of is at the time when we sell the option. And yeah, we would target again a return of 0.5% to 1% on a weekly basis. And if you are selling options on a monthly basis, then you're just aiming for 2 to 4% on a monthly basis. But on a weekly basis, it's a 0.5% to 1% of return. And you can just look at the premium, make sure you are close to that, and you also like the underlying company. And by selling this call option, you're basically just limiting your upside. If the if the price of SoFi goes, let's say we sold the call option at $14. If the price goes significantly above $14, then we miss out on all of the additional return. Let's say it went to $16, but we sold it at 14. Then we just give our shares away for $14, but we still get to keep the premium that we earned. Maybe we earn another $14 or $15 of premium, and we're okay with that because the next week we can sell a put option again for SoFi or another company and earn more premium. And we kind of are in the cycle of selling a put option. And if we get assigned, we're selling a call option. If we don't get assigned, we can sell another put option the next week. And you're in the cycle where you earn this consistent return from option selling. I hope that makes sense. If you have any questions on this, feel free to put it in the chat. I'll try to answer those. Okay, and yeah, the system that we have developed for selling options really focuses on the earnings growth of the company that we consider to sell an options for, and what that trajectory is for the last 1 to 2 years. We want to monitor our risk and limit it. So if we are selling options for individual companies, you can technically also do this for ETFs, and that would be lower risk. But because it's kind of a bundle of different companies, depending on what ETF you choose, you also get lower premium. Sometimes the premium is just not worth the option selling commission and all of that. So you have to be careful with that the option selling still makes sense if you use an ETF. But there are strategies where it can work, and you can still get maybe 10% additional ROI on top of whatever the ETF makes. You use a strategy like that. But what I mostly do in my option selling is I focus on individual companies. And when you do that, I recommend not putting everything in the same industry, in the same sector, because when we look at movements of the market or movements in the price, about half of the stock price movement is usually related to what the overall market does. 30% tends to be dependent on what the industry does or what happens in the industry in general with other companies who just had an earnings report and so on. And 20% is responsible for what happened with the individual company, which means if you have, let's say, all of your individual stocks that you sell options for, they are all in the financial technology space. If some crisis happens there, then all of your stocks will be lower, and it might be hard to sell call options for premium for a while. That's why it's good to be more diversified. Maybe financial technology companies are trending a little bit lower, but you still have some healthcare-focused companies that are doing well, or energy-focused companies that are still doing well, or at least didn't drop as much, and you can still sell options for whether call or put and earn returns. So that's where diversification across industries and also individual stocks can help kind of reduce and manage your risks more. Yeah, I mentioned the importance of price volatility already. That kind of determines the premium. And this is where you can look at the Greek metrics of the option if you want to study that more. I'm not going to cover that in this webinar because I don't think it's essential to get started with selling options profitably. It's more like if you want to get technical about it, do long-term analysis, then you can kind of compare different strategies by looking into all these details. And it gives you a little bit of a history on how the option behaves for that particular stock if you look at those metrics. What the price volatility and what the premium is like on different expirations, that already gives you a pretty good picture. And when you look at premiums and you notice that they are a lot higher than 1% a week from 1 week to the other or from 1 month to the other, that's oftentimes the case because you found a month or a week where the company is having their earnings report. And whenever that happens, because of the uncertainty about earnings, oftentimes the stock can move 5 to 10% or more up or down after an earnings report. Because of that, the options premium is a lot higher in those weeks. I would advise not to sell options in those weeks and kind of either wait the week out or sell something for a different company because it's very easy to be caught on the wrong side of the earnings report. And then you might be stuck with the stock and not be able to to sell options profitably for that stock for a little while, it's better to avoid those not so ideal assignments, I would say, and rather have your consistent profit every week, 0.5%, 1%. That adds up to a nice return, and we don't have to worry about making the huge returns in the earnings report weeks. So that would be my recommendation there. And then for choosing the individual stocks, always look at the intrinsic value. They are great tools to look deeper into what happened with the company and how their recent earnings reports went. Yahoo is a good resource there, but most stock brokers also have some decent tools that let you see at least the basic metrics, and sometimes they also have some deeper analysis. Okay, I just see we have a question here. Do you wait 1 week to sell the call option? Okay, that's, Gerald, you probably mean by that question, when you get assigned on a stock, do you sell the call option? Let's say you got assigned on a put option. Do you sell the call option right away, or do you wait a week for a price to recover? And that's actually a great question. It depends really on what happened in the overall market and what happened with the stock, and maybe also what my overall portfolio is like. Do I already have some call exposure in other companies, and I'm not really eager to sell another call real fast? Then I would wait a week, and hopefully the market will recover some, and then I can earn more premium. But it's not an easy decision to make, because oftentimes when the market has moved a certain direction, chances are it might go that same direction a little bit more next week if it's trending, if it's not just bouncing up and down. So then waiting a week could also make things worse, and you get less premium for your call option. So if you're a little bit concerned about not getting enough premium or being assigned at a price that's not ideal, then what you can also try is to move the strike price of your call option a little bit above the strike price of the put option you had, earn a little less premium, but you also make it less likely that you get assigned. And if you get assigned, you make the additional $50 or $100 from the difference between the put strike and the call strike, and that kind of improves your overall returns. It's kind of a bonus return, but you still earn a little bit of money as you wait for the price to recover. That's something I would consider there. I hope that helps. Okay, let's look a little deeper into risk management strategies. So one thing that I've seen people do that are in the options selling business, so to speak, they actually view it as a business for a longer period of time. They keep a cash reserve in their account. You can also have that outside of your account. But you want to keep a certain amount of money on the sidelines because when the market drops, when you have a 5%, 10%, sometimes even 20% market correction over a course of a few weeks or more, that's really when you can acquire the companies that you want to sell options for at the best prices. And when those corrections happen, it's less risky usually to sell options, especially once you see a little bit of a bottom form or some stocks to start turning around. But it's also can also be a good time not to just selling put options for, but what I sometimes do, if it's a company that I really want to own some shares on, I might also just buy the shares outright after a drop like that. And then I use my reserve, my 20 to 30% cash reserve, and kind of buy those companies then. And I either might sell some call options right away, a few weeks or months into the future, to earn some premium from that investment at that time. Or I might wait for the market to recover a little bit, and then I can sell the call off at an even higher strike price, still get good premium. But if I get called away at that price, then I made a significantly better return because I acquired the shares after market drop. And these kind of activities can improve your overall returns a lot, and they can actually help you get closer to that 90% average ROI much faster. Yeah, another thing that helps is diversification. One thing I like to do specifically here is invest 10 to 20% of the profits from selling options the share of the premium, so to speak, into the S&P 500 or some dividend ETFs. And what happens by doing this is you're basically going from riskier assets from the individual stocks and the returns from that, you're going into more stable assets like the ETFs, S&P 500, because if a market correction happens, there are more options you can have to kind of rebalance your portfolio at the time. And you can actually sell some of the ETF after a market drop. Let's say we have a 10% market drop, similar to what we had last week, depending on which metric you look at, what sector you look at. We had a decent correction last week or two. Then you can use those opportunities to sell some shares in S&P 500 and buy riskier companies, or sell options for riskier companies to improve your returns. And that's really not intuitive. Most people would want to do the opposite of that, because they tend to be more fearful when the market drops. They are leaning towards safety. And here's where one saying from Warren Buffett comes into play. He says, be fearful when everyone is greedy, when everything is going well in the stock market. Then you want to be fearful and take some money on the side, kind of what we're doing with the strategy, right? Putting into safer assets and keeping a cash reserve. And he also says, be greedy when everyone is fearful. So when the market is down, then it's good to take some of your cash and buy the companies that are now on sale, because you have a long-term perspective as an investor. You believe the market will recover, even if it takes 6 months or longer. You know your investment will pay off over the long term. And if you follow a strategy like that, I would recommend not moving it from A to B all at once. Looks like my video. Okay. Looks like we're back. Yeah, so I recommend doing that not all at once, but do it gradually. Let's say you have a 5% market drop. You can use some of your cash or some of your ETF shares, sell them, buy something a little bit more risky. Maybe then the market drops another 5%. So you have a 10% local total market drop or correction. You can take another piece of the cash and deploy that. And that way you kind of spread out your risk, but you're also not missing out on the smaller corrections that are happening more frequently. You're still deploying some of your cash there and kind of improving your returns in a strategic manner. Okay, opportunity investing. Yeah, I kind of addressed number 4 already, I think. So we can go to the next one. So this is kind of an example. Let's say we have a market drop for the S&P 500. There was an overall correction. S&P 500 corrected 5% down. But SoFi stock, being a technology company, smaller company, or small cap, as they also call it, because it trades at $15-ish, maybe it dropped a total of 20% in price, right? So at that point, selling some of the shares that we acquired during a happier market time in the S&P 500 and using that cash to buy SoFi can be a strategic move to rebalance a portfolio towards more risk when the times are not so good, when the market is kind of a little bit unhappy and more of a bearish stadium. And then over the long term, we expect this to correct back. SoFi will go back up 20%, hopefully, maybe more. S&P might go back up 5% or more. But we now traded a 5% drop for a 20% increase, basically. So we probably added like 15% in gains, if my math is right here, on the portfolio on the cash that we moved from A to B here, just by doing this little move, just assuming things move back to the middle. Okay. So what does our system look like? What tools and resources we have? So we are using a tracking sheet to monitor the trades that we make and also measure performance. That's really helpful to know, because then you can look at your returns and kind of adjust your strategy to make sure you're moving in the right direction. We also have strategy guides that we kind of give to our community that they can apply step-by-step instructions to get successful results. And then we have regular Q&A sessions where we can go over any questions and help people kind of get to the next level with having them implement the strategy. And yeah, let's look at some real results from option selling. This is from 2024. It kind of looks at the weekly return on investment, just from the premium. It doesn't look at the overall portfolio value, but the portfolio value had a growth that was comparable to this. In addition to kind of earning the premium, which is kind of the icing of the cake in the portfolio, the overall portfolio also did fairly well. It moved up maybe 20% or something like this. But the premium that was earned here added an additional, let's see, how many weeks is this? 25 weeks with an average return of 2%. So that's a total return of a little over 50% just from selling options just in half a year. So these are the kind of returns that I mentioned earlier. By getting this kind of return on average, and this is actually a little bit above average. I don't aim for above 2% on average, but we had a little bit of volatility in the market last year that kind of helped these returns a little bit in the upward direction. And then you get a nice average return. But you can also see in this graph that sometimes we're earning just 0.5% on options premium in a week. And that's also totally fine. And that probably means on some of the stocks that I'm selling options for, I was not able to sell any option, or maybe I sold some options in the week before for a longer than weekly time frame. So I couldn't sell additional weekly options here, and that's why the return is lower. But it's totally fine, because the higher peaks that we have in here where we earn more premium, they really make up for the weeks where it's a little bit smaller. And it's always good to keep that long-term picture in mind. And another thing I wanted to share that I think is really strategic, whenever you do investing, it's good to keep the tax strategy side as well in mind as well. So for selling options, for example, all the premiums that you earn, they are normally considered regular income that is taxed at the regular income rate, similar to if you had a W-2 job. And if you want to avoid that, if you want to get better returns, you can actually request options permission in your Roth or IRA account. And then all the additional profit that you make from selling options, which is something that you see in this account here, you basically get to keep that. Okay, looks like I'm in. Okay, we started the video real quick. Sorry about that. So by selling the options in your Roth IRA account, you are basically getting the profits that you see last year. This was 31%. And I actually really only used this strategy for half a year or so, and not as actively as in the other account. But still, 31% is a great return. And that's totally tax-free return. I have to pay zero taxes on that. I cannot access the gains until I'm at retirement age, I think, if I remember that correctly. Check with your tax professional. But you can always access your principal. If you need that for something, you can pull it out temporarily and then put it back in later. So that's not a problem. That's something that people do quite regularly. Okay. Somehow my video seems a little bit frozen here. I think I'm going to try to potentially reload the page. Okay, looks like it recovered by itself. It's good. Okay, Roth IRA, if you have any questions about that, let me know. But that's a strategy I recommend using. I'm currently using it in 2 of my accounts. This is kind of the smaller accounts in Robinhood, if you recognize the colors. But I also have a larger Roth IRA account with a different provider where the returns are looking a little better even. Okay. Yeah, so let's aim for that 45% average ROI. That really helps us to take our finances to a next level and change the trajectory of what we can do with our passive income. And selling options really helps with that. We can say goodbye to low returns from just investing in ETFs that have average returns, and then we have to wait a long time to get those returns. But option selling helps us to go beyond that and have much healthier returns. And as I pointed out earlier, having a community around you that is also along with you on the same journey is really helpful. That's something that we provide in our program. I recommend joining one. I'm in several communities myself where I get encouragement from other people who are moving in a similar direction. And that helps us a lot.